This is TreppWire with a special guest podcast, making sense of the midterms in the CRE regulatory landscape. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. And in joining us today from MBA, the Mortgage Bankers Association, are Mike Flood, SVP, Commercial Multifamily Policy and Member Engagement, and Borden Hoskins, AVP of Legislative and Political Affairs. I said it all. I can't believe it. Mostly people just need to know that you guys know what the heck is going on in DC, and you guys track the policy implications as they affect commercial real estate finance. So let's get started. Obviously, the midterms are first on our agenda. They're still playing out, but we've had a couple of updates in the last 24 hours. Does it mean anything?
Thank you for having us today. Yeah, so leading up to the elections, we had a democratically controlled House, democratically controlled Senate, and then, of course, Joe Biden, who's a Democrat, and Kamala Harris, Vice President, running the administration in the White House. So for the last 2 years, what we've seen is really unified Democrat control of government. And what that has meant is, aside from the Democrats controlling the agenda of Congress, committees, hearings, oversight, that sort of business, they've also been fairly successful in the legislative agenda. That's included about $5.5 trillion of legislation that they spent. Started with the first couple of months of the Biden administration. He passed the American Rescue Plan, which was essentially a third supplemental COVID piece of legislation. Then they passed the $1.9 trillion infrastructure bill, followed that up with a $1.2 trillion Inflation Reduction Act, which was essentially the condensed version of the Build Back Better agenda, which is what they spent the last 2 years talking about. So it's been a busy legislative year. And then, of course, Tuesday, during the midterm elections, what we've seen is Democrats expanded their control slightly, potentially even a little bit more slightly in the Senate, depending on how the runoff and the Georgia elections go. That is set for December 6th. That will be the last Senate election to be settled. If the Democrats win, they'll have a 51-49 control. If the Republicans win, it'll be another 50-50 split Senate, with, of course, Vice President Kamala Harris casting a tie-breaking vote. So they will retain control of the Senate. The House is a slightly different story, whereas Republicans started this Congress with a small minority, so about 5 seats short of the majority, 218 being the magic number there. We're still kind of seeping through some of these elections, some of the results, specifically in California and a couple other states, Arizona, to see what these final majorities are. If you asked any of the conventional wisdom here in Washington, D.C., it looks like the Republicans have about a 99% chance of taking the majority. And this, of course, is contrary to where we were 2 weeks ago, which was every pollster, political pundit, prognosticator, every insider, Beltway insider was saying Republicans are going to pick up somewhere between a minimum of 20 and a maximum of 55 seats. That would have been a historic majority. So I raised that point to let everybody know. I mean, I guess the common joke now is, in my next life, I want to come back as either a weatherman, an economist, or a political pollster, because all three of those lines of work seem to have about the same amount of repercussions for failing to project what's going to happen in the immediate, near, or long-term future. The pollsters have a lot of explaining to do here in these next couple of weeks, but it does look like they were right about a Republican majority in the House. Now, what does that mean for MBA, our members, or just anyone kind of generally following politics? It means that the entire agenda of Congress will now shift from unified control to Republicans holding the gavels in the lower chamber, the House of Representatives or the People's Chamber. That means they can pass bills. They'll be projecting what bills come up for the floor. They'll be calling the shots on hearings.
Well, Borden, when you say, kind of summarizing it, last administration, we had a full Democratic control. So the House, the Senate, and the president could sit down and think about what could they pass together? Were they successful or not? Now you have a situation where only the Senate and the president can sit down and do that, and the House isn't necessarily incentivized to do that. Because let's think for a minute. In 2 years, we have a presidential election. So the closer you get to a presidential election, the less incentive you have for either party to agree. So what does that mean in the way we think about it? I like to say this aloud, and a lot of people roll their eyes, but what didn't change in the election? Biden is still president. Why does that matter? Because he gets to decide, along with consent of the Senate, who controls the regulators. And as history has shown us, when you have a divided government and you're running towards a presidential election where finding agreement is hard to do, every president who gets frustrated with Congress decides to use their own power to try to get through their own ideas. Trump did that, Obama did that, and now we expect Biden to do that as well. And the four things that I would point out are important are, remember how Biden got elected and how he probably feels emboldened now was on four pillars: economic recovery, COVID recovery, racial equity, and climate change. And so everything that Biden proposes usually has one of those four lenses in it. So remember that over the next 2 years, everything that we take on will likely be under one of those themes. So the way we look at this, if you are the Democrats in Congress, your job is to help the president now with expanding his power through the regulatory body. So Democrats there will likely do their best to support what Biden's trying to do. If you're the Republicans and your natural inclination is to limit government and you want to set yourself up as an alternative view for the next presidential run, you're going to oppose it. So to Borden's point, Republicans in the House will likely throw rocks at regulators for things they don't agree with. And you'll see where the real pressure points are, because that's where Republicans will concentrate their efforts. They have the power to do oversight. They could have oversight over 50,000 things. They'll likely pick 5 or 6 that make a lot of sense. Most importantly, what does this mean for our industry? We're going to spend most of our time dealing with regulators who want to implement Biden's policies, but do it through the regulatory body. Republicans will try to limit that through oversight. And then Borden mentioned something that's very important for the whole industry to remember. Remember that over the last 4 years, under the Trump administration and under McConnell, the Senate pushed through a lot of judges. What does that mean? You'll hear the term Fifth Circuit come up a lot. The Fifth Circuit is, generically speaking, controlled by conservative judges. So therefore, when the Republicans or business or whomever doesn't like what the regulators are trying to do with the Biden administration, you can bet that the industry, if they can't have a legislative fix, which is hard to do in a divided Congress, will take it to the Fifth Circuit. So I would postulate that it's not just important to watch Congress and Biden, it's also important to watch the Fifth Circuit, because if you're going to challenge the Biden administration, the most likely court you have is the Fifth Circuit. So I think we're all going to keep our eye on that as well.
On a major oversight issue, the Consumer Financial Protection Bureau, the CFPB, is going to be in main focus, I think, is because it's an agency that was created out of the Dodd-Frank Act about 12 years ago. Not a single Republican supported the inception or creation of the agency when it came to bear. The Republicans have really gone after this agency. And that's relevant because a few weeks ago in the Fifth Circuit, a few independent private businesses actually sued the Consumer Financial Protection Bureau in the Fifth Circuit. And the judge there ruled that the structure of the agency is unconstitutional based on the way that they get their funding. It's very much up in the air how the Supreme Court will rule on the status of the agency. The Supreme Court could say the CFPB is unconstitutional based on the fact that they're not subject to congressional appropriations. They could provide a roadmap for Congress in their opinion, or they could go in a completely different direction and maybe go contrary to where the Fifth Circuit ruled. That, of course, brings into question the longevity or the status of the future of the other independent regulatory agencies, such as the Securities and Exchange Commission and the Federal Housing Finance Agency.
Saw a presentation you started handing out over late summer. You talked about the most likely scenario being exactly how it turned out, which is a narrow Democratic Senate, a narrow House for the Republicans, and of course, Biden still the president. So congratulations on really getting that right when a lot of the pundits were wildly off in various directions. So you really nailed that. I want you to walk through all of the different components of what could happen over the next 2 years. But before that, I'd like to get into what can happen over the next 6 weeks, right? We talk about this lame duck situation where often Congresses will try to jam through something that they couldn't get through before the election. To me, as a real outsider, I am as far from a political wonk as you can be. It sounds a little bit like running a Sweet 16 party for your daughter, right? If it's a real success, you might get 1 or 2 attaboys and your daughter's a little bit happy at the end of it. If it goes sideways, you have uninvited guests, the GJ's terrible, right? People are sneaking in alcohol into the party and it's terrible, right? Has that been your experience with the lame ducks before? And is there anything that CMBS or CRE investors should be worried about in the next 6 weeks that could really be a 2x4 to the back of the head?
Yeah, so you're probably right about the potential for, both a disaster, but also kind of a benign, I guess, is a victory in a lame duck. To sort of set the stage of what needs to get done, again, I mentioned the appropriations bills earlier, right? That's the funding of the government. So typically, I guess going back to about 2012 and before, Congress would get together every spring. They would lay out an agenda of a budget, essentially, and then start working on a huge bill that would fund the government for a full fiscal year. And so they would do that every year. It was called the appropriation season. They usually pass those bills in June. They get them signed into law in September. And then they would start that process over again every year to make sure we had continuity along the funding line. Since about 2012 or 13, I guess, we have been operating in perpetuity under what's called a CR, continuing resolution, or an omni, or a minibus, which is essentially a smaller, lesser time frame extension of government funding. They can be anywhere from 6 weeks, 1 day, 6 months, it depends. So what needs to get done in this lame duck session is we have to fund the government, because funding expires, I believe, in December. If Congress in the lame duck, which again will still be run by a democratically controlled House and a democratically controlled Senate, because it won't be sworn in until January. But also add to that, there's this debt ceiling issue. Some of the Democrats have already been talking about doing another bill in the lame duck that would essentially extend the debt ceiling and make that go through a year to avoid any funding issues for the Biden administration on any of their prerogatives, whether it's a rulemaking that OMB would have to approve or legislative or what have you. And obviously that gives the government a little bit more bandwidth to sort of continue paying debts, obligations on the Treasury. So first and foremost, funding bill appropriations, that will need to get done. Debt ceiling is a big deal, and the appropriations are a big deal for the industry. Obviously, if HUD and FHFA, or specifically if HUD doesn't have the funding, I mean, it's hard for them to approve any loans, especially on the FHA front. Mike can tell you all about that, what he's been hearing from his guys over the last 2 years. They're already underfunded in a lot of those deals. And then, of course, when you talk about the debt ceiling, the ability to continue borrowing and what that means for the Treasury markets and how, people maybe borrow against those, that's sort of a longer term implication, but creating that really liquid appetite and the Treasury bond market, I think, is also important. So I think those would probably be the two most critical to the commercial lending space, but it is Congress. Somebody could drop a bill tomorrow and then we would be all over it, but that's TBD.
What I would just add to that, man, is no government funding means no FHA lending. If the debt ceiling is taken care of now, I would posit that the country could kind of breathe a sigh of relief, because typically if there's a debt ceiling debate, as we have seen historically, and the House and Senate are in different hands, both parties use that to extract something in the budget process from the other party. I would posit that both parties have gotten a little more diametrically opposed. So every time we get closer to a debt ceiling crisis, puts us that much closer to a downgrade, especially in a counter-cyclical environment. So if the debt ceiling can be done now, while politically it might be painful for Republicans, it might actually be better off long-term, because we'd have that out of the way and it wouldn't be used as a stall tactic. So we have death and pestilence and war. We're just trying to avoid the debt ceiling.
Good one.
In the past, when FHA has come under this threat, where does lending come from for that part of the market? Where does it come if that comes to pass?
It's a great question. If it's truly affordable, that's a tough question. You almost have to go to a PHA or a local. But if it's going to fit in that 60 to 80% AMI bucket, it probably runs over to the GSEs relatively quickly, especially in large cities. But again, if we get into affordable loans that aren't in large cities, quite frankly, it could actually be a benefit to CMBS. Now, granted, that's a ways off and there are other factors at play, but you're absolutely right. First stop GSE, second stop private sector. And right now, debt funds, quite frankly.
So, Mike, you brought up the GSEs. It looks like they're staring at a few rulemaking coming up here, fourth quarter 22 into the 23 year. Can you give us a little color on that? I know lending caps are usually a hot topic. I mean, anything that we can glean from what they're sitting on and what's coming for them.
Yeah, sure. Actually, Lonnie, great layup. Thank you. Caps got released last Thursday. And here's a little comparison of where I think it could be good for different types of lenders. Last year, the caps were $78 billion per GSE. This year, there's $75 billion per GSE. As you can imagine, looking at origination numbers from Jamie Woodwell, our economist, as well as I'm sure your own, multifamily originations are projected to be down from last year. Two, it doesn't appear that either GSE is going to reach their caps this year. So, which would suggest lowering them is going to be something where the private sector will be involved. And three, I think what's important about the 75 billion is twofold. One, the FHFA, considering we're in a rising interest rate environment, said, look, if the market ends up being smaller than we project, we're not going to lower the caps. So if you're a GSE lender, you like hearing that. And if you believe in their mission as a counter-cyclical lender, you like that. If you're a private sector lender, you may not like that, right? Because if the market goes down, you want that business in your own area. So good for GSE lenders in this. They also have simplified the goals. And what I mean by that is, of the 75 billion, 50% still must go towards mission focus. But of those mission focus goals, I think you and I could sit down with a spreadsheet and a matrix, and it's still hard to track what they have to do. But very simple things that we're very happy about, and I think the industry should be happy about, is they got rid of the 25% of the mission focused on 60% AMI. You know, at first that sounds like, hey, why would you do that? Shouldn't you be helping people who are worse off, for lack of a better word? Well, the FHA does a lot of this. And B, when you look at the overall mission, they're kind of getting there with their current lending anyways. Two, I think they realized with the green bonds that were outside the cap that they wanted to produce for energy efficiency, they're bringing that inside and counting that as mission focused. So they're trying to incentivize lenders not only to do affordable housing, but to do clean affordable housing, for lack of a better word. So that's part we're going to monitor and see how that goes. I also think a bonus for the private sector in all of this is small balance loans. Last year, the GSEs, in essence, were asked to produce about double the amount of small balance loans that they're typically asked to do. And quite frankly, either there wasn't the volume or there wasn't the incentive to do it. And our research shows that a lot of the small and regional banks are very happy to do the small balance loans. So that's been reduced by half. I think it's good to have the GSEs in the market, but I think it's better to be able to acknowledge where the private sector succeeds and allow that to happen. An interesting one, as I like to say, I never thought in my career of lobbying I'd ever talk to you about radon, but I'm about to. There, in the fourth quarter, there will be a ruling likely from the GSEs on how much extra radon testing is needed. And let me back up. For every property, before a loan is made, and you all know this, we do some form of radon testing to make sure the property's safe. And if rooms need to be vented or changed, that gets changed. The EPA has zone maps that say where the high and low risk areas are. And at the end of last year, and you'll love this, there's a trade association for everything. There is a radon testing trade association. And I think they saw, and I will be blunt here, that their market was shrinking. So they created a study on their own and said, hey, we did some radon testing in some high risk areas, and we found out there's more radon than you think. And so they handed that study to HUD, and HUD implemented it. The amazing thing about that study is on page 5, it literally says you cannot use this data to make national conclusions. So testing went from 10% in ground floor and 10% random in every unit above that to 100% ground floor, and then 10% for every floor above that. The question isn't about health. The question is it even necessary? And are there actually enough radon testers out there to do this? Why is this important? Why am I harping on radon of all things? If the testing that the GSEs decide to implement comes back strong, yes, it's implemented at HUD, but the timeline to complete a HUD loan is a year. The timeline to complete a GSE loan is 60 days. Those two groups make up 55, 60% of the multifamily market. So if radon testing gets increased there, I would posit that would become a market standard in the private sector as well. So again, it's not about health, it's about using good data and making sure there's enough radon testers to actually get the job done. That sounds small, but it's a significant one for the entire market. And then 3, I think a bigger one, Lonnie, that we're all going to be concentrated on, and the private sector should care about in multifamily, is there are a lot of questions under the idea of racial equity and, quite frankly, social equity as to whether there are enough license holders at the GSEs. Are they providing licenses to minority businesses, to female businesses? Are they serving those customers? So I think there'll be a big question about whether there should be more GSE licenses or whether those that have GSE licenses should be doing more through maybe correspondent channels to help women and minority borrowers and lenders. So those are the top three I'd be looking at, Lonnie, on the multifamily side.
Let me go back and follow up on a couple of things on the liquidity side and the lending side. As I mentioned before, I was looking through some of your recent presentations, which I understand are freely available from you, Mike. If our listeners want to reach out to Mike on LinkedIn, there's a lot of background in these. But there was two things that jumped out at me. You know, I didn't even focus on the FHA stuff until you brought it up a little while ago. But in the presentation, you talked about greater scrutiny of non-bank lenders, right? That's going to be a priority. And then later in your presentation in the Community Reinvestment Act, you talk about how there may be incentives for banks to focus more on consumer loans and less on multifamily loans. So that's, kind of two areas where, in the one sense, a lender might be under more scrutiny and therefore be able to lend less in the non-bank area. And then in the other area, like the incentives are changed, so banks are less incentivized to do lending. Does this change the liquidity, the amount of available capital in any meaningful way?
That's a great question. And you actually hit on the perfect example, which is, and I think this actually comes from the residential side. And let me explain. I think that since Dodd-Frank was implemented in the great financial crisis, we've all clearly seen a shift on the resi side from lending out of banks to lending out of non-banks. And I think the natural question from regulator, even though we disagree with it strongly, is, well, if residential lending is now happening out of non-banks, should they have Community Reinvestment Act requirements as well? Our data shows that, and I'm sticking with resi for a minute to get to the commercial side, says that, hey, look, you put in rules that were so onerous that it wasn't financially accretive to a bank to do a resi loan. So now the non-banks are doing them. But if you look at the data, they're actually providing better loans to more of the folks you want to have loans than banks are. So is this really something you want to require as a Community Reinvestment Act where it's actually not needed? And then you also have to take on the legislative play in all this. If I'm a bank, of course I want that for IMBs. If I'm a non-bank, of course I don't want that. So you have the interplay of who's lobbying against what. So now let's take that over to the commercial side. Well, as we know from Dodd-Frank, if it happens on resi, clearly commercial must be the exact same business. And we all know that's full of it. So the question then becomes, should Community Reinvestment Act in some way also involve non-banks that are commercially related? Should they have a responsibility? And then, Manus, to your point, what confuses us is you have a proposal out for banks. Let's go back to the bank side on the Community Reinvestment Act, which is basically a rule that says, hey, you have a responsibility to invest in your own neighborhood, in your own area. And what used to happen is the mix of what counted towards those in Community Reinvestment Act credits is changing on the proposed rule. In essence, and I will say this a little bit wrong, you were incentivized more to invest in a commercial loan like a multifamily loan than you were in a consumer loan such as an auto loan. It was a 60-40 split. Under the proposal, that switches to 40-60, meaning you have more of incentive as a bank to make an auto loan to count towards Community Reinvestment Act. So that's our question to the government, which is, well, if you want to produce more affordable housing, and the biggest provider of capital and commercial real estate is banks, hands down, why would you disincentivize them to be invested in multifamily? Understanding it is an income producing property, so let's be careful on how disincentivized they are. And at the same time, if you want to produce affordable housing and you look at the data for an independent mortgage bank that's actually doing better than Community Reinvestment Act, then why do you need those rules? So you are making the advocacy argument we're trying to make, which is, shouldn't you want both of these?
Obviously, the Trump administration also tried to rewrite the Community Investment Act rules unsuccessfully. They were able to get one agency to adopt it. What you really want from our perspective is a joint interagency rulemaking, right? You want one set of rules for CRA, which is good. So in that respect, the Biden administration is tracking because they do have harmony on their agency front. But also, don't forget the CRA stands for Community Reinvestment Act. So if you're and we at MBA do represent both, but if you're not a bank, you're not taking deposits. That is the genesis of the rules, to take in deposits and reinvest them in a community. So if you're not a depository institution, any non-bank lender, you really, the argument of should you even be subject to CRA is not really relevant. And also, again, keep in mind that a lot of what the type of lending these people do. There aren't a lot of institutions that are going to fail their CRA exam regardless, even if it was non-banks or banks, right? Like everybody, you were going to be in compliance with this in 2022 and beyond. So the legislative front in tandem, I mean, there is legislation to significantly expand CRA. It's debatable about whether or not they would need legislative authority to do that. Our position is obviously that we think that in order for the regulators to impose CRA on non-bank lenders, they would require additional statutory authority by Congress. They cannot do that on their own, but that doesn't mean they won't try.
But in short, the combination of these two, higher scrutiny and CRA changes, is there any scenario under which you see like liquidity, funding availability, which has been so incredibly plentiful, especially from the non-bank banks, getting crimped? Is that, or is that just, am I reading too much into this?
I think in the most extreme category, Menace, you're not wrong. And this is what I think. I think banks are on the sidelines right now, right? Because they're sitting on their portfolios and making sure those are stable, and we can't price anything right now. Now, non-banks have to watch their funding. But in our world, we have our catch-all. Good, bad, or indifferent, we have the agencies. And we have the GSEs and we have FHA. So I think, to your point, you could get a liquidity crisis, but I think the government has proven, whether we like it or not, what happens next. I think all the business all of a sudden starts flooding to the FHA and the GSEs.
All right, we heard the big exhale from our audience right there, that unlikely to create a liquidity crisis. We like that.
I've seen a lot of news lately coming from a lot of different parts of the country on tenants' Bill of Rights, renters' Bill of Rights, coming from the likes of everywhere from New York, Buffalo to Sacramento, California. And I think a lot of this was possibly brought to the surface as a result of COVID. And you had a lot of eviction moratorium and other things, obviously, that were putting pressure on landlords as they were trying to navigate a very unprecedented time.
Yeah, you've hit the nail on the head, Martha. As a matter of fact, on Monday, we were invited to the White House to speak on tenant protections with both borrower owner groups and lender groups. And you're right, the White House has a belief that renter protection should be enhanced. As you can imagine, we don't share that belief. And even here nowadays, because of inflation, you hear tenant groups asking for rent control, which we all know is clearly not the answer. And if you want to halt agency originating in its tracks, implement rent control. But what's important is the industry should be watching DC over the next couple months, because the idea is to see if our groups and tenant groups can get together and find ways to make sure that tenants can have a safe place to live and have decent, affordable housing. You know, clearly we have you all to protect, tenants have tenants to protect, but we're going to work hard over the next couple of months to see what is doable and what is not. But you're absolutely right, Martha. And I would even say, watch the CFPB here. Every time the government wants to do something, they put out a report saying how bad life is. And CFPB released a report today to say that the credit checks on renters are terrible. Now, whether that's true or not is a good question, but that every time you see the CFPB stand up and say something's terrible, understand in 3 or 4 months, they're likely to take some action. All right, I wanted to run through just 2 or 3 things for each form of finance that we think is coming. So start with life insurance companies. To the good, we were very happy to work with ACLI to lower risk-based capital standards for equity investments. There's a little sliver left to do on CM6 and CM7, which is distressed debt. We and ACLI have handed in our proposal. NAIC has had a couple questions. We do expect by the end of the year to that to be conformed, which we think is helpful. That's the offensive part. On the defensive part, if you are an insurance company, we are getting increasing questions from the NAIC on private equity ownership of insurance companies. So what are we going to do about it? We want to distinguish very much the difference between private equity ownership of an insurance company and insurance companies lending through debt funds in order to get better yield, plus the look-through approach. So our task force of insurance companies is sitting down to honestly just draw the picture of what do those two models look like and how do they work, so that we can educate policymakers. So when they decide, and the key word here is when, they decide to regulate private equity that owns insurance companies, we are pointing them to the right place and not enveloping other parts of the business.
So it sounds like on that front, you're not worried about, from just the tone of your answer there, private equity influencing insurance company decisions and pushing them into riskier assets?
We are worried about that. Let me put this in DC context, right? Remember, this town is made up of 21 and 30-year-olds who don't make a lot of money, who have to try and make decisions for their bosses. There was a hearing a month ago for Sherrod Brown, and that hearing was about, will policymakers be able to get the money on their policies? Very much a higher level if private equity is involved, not commercial involvement. But Manus, I do think the first question a regulator has is, what kind of risky stuff are you getting into? So I do think that is the question, but we want to distinguish between private equity owning a company, and what does that mean, and say an insurance company who is lending through a debt fund, because I'm not always sure that those are explained very well here in DC. For banks, we kind of covered it. They will likely face higher capital charges. They will also have a relook at Community Reinvestment Act. What does that mean? Less turns of commercial real estate. And then I would like to say, for debt funds, for structured finance, I'm actually more concerned about climate change. Let me explain. The SEC has a ruling out about potentially collecting data on climate change and the loans we do. The important part is there's a scope 3 in there. And what it says is, should we or should we not require companies to collect information on downstream events? What does that mean? If you are a lender and you lend to a building under scope 3, it is there is potential that you as a lender might have to report to the SEC on what's going on annually with your borrower's building. Is it decreasing, or is it becoming more efficient? The good news is, let's go back to our first question on the Fifth Circuit. The SEC now has to make a decision under Gary Gensler. Do we push forward with requiring downstream disclosure reporting when most lawyers would look at you and say, you, SEC, don't have the authority, and they would likely get sued in the Fifth Circuit, and in my opinion, likely lose? Or do they drop that part and go forward with scope 1 and 2, which would not affect our business, but it would at least get the high level disclosures out about what businesses are doing? So I think we watch that. And then my favorite category is the regulation for all category. And this is our friends at the CFPB. Two things that need to stick out. We already talked about tenant protections and Bill of Rights, and stick with us over the next 2 months. We'll keep you informed. But the other one is called 1071 business reporting. You'll hear a lot about this from us and others. Again, the intent of this rule is to find out whether women and female businesses are receiving the same type of credits as guys like me. And that's a real laudable idea. Our concern is that it's collecting information on small business lending. We don't think we do small business lending. We think that that means the operations of the business and a female or minority going to get that money and making sure they get the credit. Unfortunately, at this point, commercial is roped in. So if the proposed rule were to go through, our servicers would be collecting data on very small loans, likely 5 million or less, and likely on the operations. So we have asked for an exclusion, as have our trade association friends. That will come out in March. We want to keep our eye on that one as well. And then finally, HMDA data reporting. Let's go back to the Fifth Circuit. It used to be under HMDA, and we can talk about the ridiculousness of this another day, that commercial firms that do over 100 loans over a 2-year period must report HMDA data. Some smaller groups, trade associations, didn't like that CFPB ruling. So they sued the CFPB in the Fifth Circuit and won. Now, as of October, the reporting limit is 25 loans. That ropes in a lot of very small companies and a lot of small insurance companies. The CFPB under this administration has zero desire to appeal it. So now 25 loan reporting is the law of the land. So we are working to help our lenders learn how to report. We're also asking the CFPB to exempt companies who did 25 loans last year, but will never do 25 loans again. Why set up a CRA structure at great expense for a 1-year report? That's going to be important over the next 2 months for everybody to pay attention to. So long story short, with all this, it's regulatory. We're on defense here in the Fed government, but we'll be on offense in the state levels where we can make some hay on tax refurbishment credits for, say, office buildings. But I'll stop there, Manus. And that's what's keeping our members up. And that's kind of what we're keeping our eye on over 2024.
Well, thanks, Mike and Borden, for breaking down Obviously, you guys are paying close attention to this. So if you have any questions about that, they can probably reach you at your website, but we're happy to also make the connection if you want to reach out to us. So we'll close this special podcast. Thanks to our producer, Haley Keene. Join us this week as we look at what's happened during the week and how it may be impacting you. If you have a question, send your email to podcast@trepp.com and visit trepp.com for more information and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.